In this video, we will be talking about how Forex, CFDs, futures and options differ. When people say they trade the markets, they're not always talking about the same thing. There are different types of financial instruments, and each one works a little differently. In this video, we'll explain the four most common trading assets: Forex, CFDs, futures and options. We will cover what they are, how they work, and who typically uses them. Forex, or foreign exchange, is the global marketplace for trading one currency against another. You are speculating on how one currency will perform relative to another. For example, whether the euro will strengthen against the US dollar. It's the largest and most liquid financial market in the world, trading over $6 trillion per day. Forex markets are open 24 hours a day, 5 days a week, and are influenced by interest rates, inflation, central bank policy, and economic news. CFDs, or contracts for difference, allow you to speculate on the price movement of an asset without owning it. You can trade CFDs on shares, indices, currencies, and commodities. You are entering into an agreement with your broker to exchange the difference in price between the time you enter and exit a trade. CFDs allow you to go long, betting price will rise, or short, betting it will fall, and they use leverage, which means small price changes can lead to amplified gains or losses. They're widely used by retail traders because of their flexibility and low cost of entry, but they carry real risk. Futures contracts. Futures are standardized contracts to buy or sell an asset at a set price on a specific date in the future. They're commonly used to trade commodities like oil, agricultural products, or financial indices. Futures were originally created to help businesses hedge, like a farmer locking in the price of wheat, but they're also widely used by professional traders and institutions for speculation. These contracts are traded on regulated exchanges, have fixed expiry dates, and require margin. Futures can be highly liquid but also volatile, so understanding contract specs and managing risk is key. Options contracts. Options are contracts that give the buyer the right, but not the obligation, to buy or sell an asset at a set price within a specific time. There are two types of options. A call option gives the buyer the right to buy the asset. A put option gives the buyer the right to sell the asset. When you buy an option, you pay a premium. You don't have to use the option if things don't go your way. You can just let it expire. But if you do decide to use it and exercise your right, the person who sold you the option has to follow through with their obligation. Options are used for hedging, income generation, and directional strategies, but they involve more moving parts like time decay and implied volatility. To summarize, each of these instruments is a tool, and like any tool, how you use it depends on your goals. Forex is fast-moving and accessible. CFDs are flexible but leveraged. Futures are structured and widely used by professionals. Options are versatile but require a deeper level of understanding. The important thing is not just choosing a market, but choosing the one that matches your time frame, style, and risk appetite.